Good morning, everyone, and very welcome to this SEPS webinar, the Basel III Finalisation, the Impact on Banks and the Real Economy Across Scenarios. I'm very pleased to moderate this webinar, this summer webinar, although I have to say that the weather in Brussels is anything but summerish with our 13 degrees this morning. But yet I'm pretty sure that the debate will be quite hot in the next hour. Now, before we get into the discussion, let me say a few words to set the scene. So in the last 18 months, basically all of us have been focusing on COVID, but we should not forget that there are other things going on, and certainly the implementation of Basel will represent a significant element in the regulatory frameworks for banks in the European Union. Now, the Basel reforms basically are the results of the post-financial crisis changes which have been implemented, and basically the idea was really to strengthen the capital standards for international operating banks. Now, in the context of Basel, the key variable is really the risk-weighted capital requirements. And in the reform process, basically we had two phases. The first one really focusing on the numerator of this ratio. So it was really about the quality and the level of capital. The second phase and the last phase of Basel is really focusing instead on the denominator of the ratio, namely the calibration of the risk-weighted assets. Now, the Basel standards are traditionally implemented in the European Union, and in fact, in the first phase, the reforms translated into the Capital Requirement Directive, the fourth one, and then in the Capital Requirements Regulation. Now, one question is how the finalization of Basel III and this second step will be implemented in the European Union. And what will be the consequences of the implementation of Basel on minimum capital requirements, but also on the activities of banks and the real economy. Now, to answer these questions, I would like to invite my colleague, Willem Peter de Kroon. Willem is a senior fellow at SEPS and the head of Financial Markets and Institution Unit at SEPS, and is the principal investigator of a new study that SEPS will publish while we speak. So this will be available on SEPS website, and all those who have registered to this event will also receive directly the link to check it. So I would like to ask Willem to present the main findings of this new study. Willem, the floor is yours.
Thank you very much, Cynthia, and good to see that we are with this many this morning, and of course also happy to present our newest study on one of the key issues in banking, and I think already that carries for us for decades, and that's also why it's of course Basel III, or some may know it better as Basel IV, the finalization of the Basel, so post-crisis, Basel response, at least to global financial crisis, post-crisis, because of course we are unfortunately already encountering the next one. So today I will be presenting the key findings for the entire results. Of course, I refer you to the study as we have provided results in quite great detail, but unfortunately the time does not allow to go into that detail during the presentation this morning. What did we try to do in the study is primarily look at what is the impact on banks, and then derived from that the real economy. In the presentation, I will primarily focus on the impact on banks. In the discussion afterwards, we might also go a bit into the impact on the real economy. We did that through a bit of a scenario analysis. We all might have seen, or you all might have seen, the EBA impact assessment, which already provides at least I think, a quite good indication on what the direct impact would be on the static balance sheet assumption for the European banks. We try to see, okay, we know that this is the impact if you look at the regulatory requirements, but we of course know that banks have to hold some buffer on their regulatory requirements, because otherwise the risk of course, failing. At the same time, we also know that banks might adjust their balance sheet after the implementation of the requirements. So these are two aspects that we wanted to capture in the study. And then also we see that there are different ways for banks to respond to high requirements. Either they just take it from their buffer, but it's likely that they want to increase their capital ratios. So then you're more thinking about keeping retained earnings, potential deleveraging, changing the portfolio distribution, or for instance, issuing new instruments. And then the last scenarios that we considered was changing the way of implementation, in particular with the output floor. But to that I will come back in a minute. If we then look at how we did this, so we took the EBA results as the base. So we took the results at country level, or if those were not available for some of the countries in which the banks are active, we took the size of the bank as parameter. Then we looked at the impact as measured by or estimated by the EBA, and we distributed across the banks in that country based on the various keys which are, according to us, most likely to capture the actual distribution of the impacts. We have tested this also on some of the banks for which we had more detailed results, so that we know that this approach is fairly accurate. However, as we don't have the individual bank level data for the impact assessment of the EBA is not published, so this means that we had to make a few assumptions. Nevertheless, based on the results that we could test, we think that it gives a quite good impression of the individual bank impact. Now, we in addition made a few additional adjustment based on national supervisors that came with adjustments afterwards, and that way we estimated the impact. So that way also you can say that the starting point of our exercise is fairly similar to the results of the EBA impact assessment. We applied this approach to all the banks that were subject to the transparency exercise in 2020. We took the autumn one, so that already considers part of the impact of COVID, because the cutoff date was June 2020. This covers 135 banks from 27 EEA countries plus the UK. In total, they represent more than 70% of the EU banking assets. So in that sense, I think also we make sure that the exercise is quite representative for the entire EU banking sector. If we then go to the impact of Basel III, so this is basically a translation of the results from the EBA, we see that overall, if we look at the entire sample, the banks are likely to experience an increase of 2.3% measured in risk-weighted assets. So there's a different measure than used by the EBA. Where does that fall down? So we see that of course, there are some increases due to different approaches to standard approach, internal risk weights approach, credit valuation adjustment, as well as the operational risk changes. However, the biggest individual change comes from the output floor, which is representative of about a third of the total impact. Important here is, of course, this is looking at all banks, but not all banks are equally affected. So if we look at the distribution across countries, we see that we look at the banks group level, so where they are located, then we see that the biggest impact is in the banking sectors in Germany, Netherlands, Finland, France, Sweden, Denmark, and the UK, where you all see that the impact is more than that 2% of risk-weighted assets. If you look also a bit at the distribution, what kind of measure as part of the Basel III finalization has the biggest impact, you see that almost all of these countries have particularly a large impact of the output floor, although also the other measures have an impact. If you go more to also countries with some smaller banking sectors and that don't use mostly the internal risk, but you see that other measures like the operational risk or the standard approaches are having a bigger impact. If we look at the different types of banks, of course, we see that the biggest impact is with the larger banks. If we look at the business models, we also see that it's primarily retail investment banks and less so wholesale banks. If we look at ownership, we see that it's fairly equally distributed. Only the public banks are, according to our estimations, having a lesser of an impact. Of course, impact does not necessarily mean that also all these banks would have to increase their capital in response to the Basel III finalization. If we just look at the total regulatory requirement, including also the different buffers, we see that of these 135 banks in our sample, about 18 or 13% would experience a total shortfall of around 38 billion. I mean, this is relatively limited if we consider the total capital of the banks at the moment. However, if we would look at what their shortfall would be on their current capital level, so why did we take current capital level? We expect that banks will have to increase, raise their capital, and it will be somewhere between their ratio after the shortfall and their current level, because in principle they don't need to hold a higher buffer than they already have. And it's very hard to determine what is the exact minimum ratio a bank would have to hold, considering this own margin or buffer on top of the legislative and supervisory requirements. So we expect, and then the impact will be somewhere between the total regulatory requirements and the current capital ratios. So if we look at those current capital ratios and the shortfall on that, you would expect a shortfall that's about 10 times as big as the one based on the total regulatory requirements, or around 400 billion euros, which is around 3.6% of risk-weighted assets, which is of course more substantial if you compare it, for instance, with the traditional 8% of total capital requirements that we have been discussing for years. So that it's about 50%, which is large. It would affect the large majority of the banks. We estimate that in that case about 90% would have to take measures. Now, moving to the different scenarios and how it would fall down. If we look at, in particular, the regulatory requirements and to what extent those shortfalls could be addressed with retained earnings, you see basically, first of all, of course, that most of the banks would not experience any shortfall. And a large part of those that would experience a shortfall would be able to absorb it if we assume that the 2019 retained earnings would be a good predictor of future profitability. So then about half of the banks with a shortfall would be able to cover that within the transition period. Other banks would require some more time, or were in 2019 loss-making, so they would not be able to use retained earnings in order to repair or to reduce get rid of the shortfall. If we use again the current capital ratio, you see that of course that many more banks are experiencing a shortfall, and would require several years of profits in order to address this shortfall. In general, you see that around 20% would require more than the transition period to address these shortfall based on 2019 retained earnings. Of course, since 2019, a lot has happened with COVID. Also, we know that there are certain trends that are putting pressure on the profitability of banks. So it might well be that the profitability levels go down from the pre-crisis levels. So if you look, for instance, what would happen if we would have 2 years of the same profitability directly after the outbreak of the COVID crisis, so that's the profitability of the first half of 2020 extrapolated for 2 years, then you would see, and then afterwards through 2019 retained earnings, then you would see that significantly more banks would not be able to fulfill and address the capital shortfall on their current capital requirements within the transition period. Of course, this assumes that they would go for the same capital levels as they currently have, and that the profitability will indeed be distressed for 2 years, which is, of course, remains to be seen, given also the uncertain times we are in. At the moment that this would materialize, of course, it means that some of the banks might have to consider alternatives. One of the alternatives would be raising capital. You see that this is possible for quite a large share of the banks. Nevertheless, of course, we have many cooperative savings banks that are also among the ones experiencing shortfall, which are more active in retail banking. So those would have to look also for alternatives beyond retained earnings and additional capital issuance. One other possibility would be deleveraging. If we look at that, of course, we immediately, if we look at the results, see that those banking sectors, so that in which banks are active that experience this shortfall, would have to deleverage much more in order to address the shortfall than those where there is none. If we look at the impact, we see that in order to meet the regulatory requirements, there would be an overall reduction of around 2%. And if you want, if they would like to go to the current capital requirements level, it would be around 20% or 6.5 trillion. However, the differences are quite large across countries. So you have many countries in which there's basically no or a very limited impact, but you also have countries like Denmark and Sweden where you would have to deleverage more than a third of the balance sheet in order to reach the current capital requirements. Also for the regulatory requirements already in those countries, there might be some significant deleveraging necessary if there is no retained earnings being kept or issuance of capital or any of the other scenarios. In practice, you would expect, of course, that banks use a mix and also not only do deleveraging, but potentially also changing the composition of their portfolio. We looked also at this. For this, it's interesting to look, first of all, at, okay, we know that, for instance, with the output floor, which is applying on the standardized approach, you take 72.5% is the, so basically overall standardized approach, 72.5% would be the minimum in credit risk that you would have to meet. So it's primarily affecting banks where there is a big difference between the standardized approach and the internal ratings approach. If we look at which ratios, so which exposures actually have this large difference between the standardized and internal rating-based approach, we see that it's primarily the exposures to corporates and the exposures to retail. So you would expect, at first sight at least, that the biggest impact would be on those exposures. We did a fairly simple scenario that banks would shift their exposures from higher risk-weighted exposures to lower risk-weighted exposures. In that scenario, you would see a significant shift from the more corporate and non-secured retail exposures to more secured and primarily central institutions and central government and exposures. So this would be a potential impact. Interesting in this sense is that this was also what we saw a bit after the financial crisis, where we didn't see really a reduction in exposures, but we saw very much a change of exposure indeed to more of these exposures with a lower risk weight. So this might be potentially also an impact that the new Basel finalization might have. Now, so these were all basically just the banks taking a decision on how to address the shortfall, or at least the higher capital requirements. Now we move to say more the implementation of the measures. In the report, we look at different options, but I think the most discussed one is basically the parallel stacked approach. In that one, the output floor is only applied on the considering the requirements, excluding the European specific buffers. And what we basically see there is that the shortfalls would be significantly lower as well as the capital demands if you want to meet the current capital levels. So we see basically a reduction of almost 2/3 of the regulatory requirements shortfall, and around 1/3 in the shortfall on the current capital level. So that would go from around 400 billion to around 250 billion. In number of banks affected, you see that it's primarily having an impact on the regulatory capital affected banks. So there it reduces by more than 50% from 18 to 8. And for the current capital level, it would reduce only by 3 from 180 to 115 out of the sample of 135. Good. Let's briefly go through the conclusions and recommendations. Overall, we haven't discussed it too much, but you see that the Basel III finalizations very much address issues that were not addressed in the first round of revisions under Basel III, focusing on the shortcomings of the risk-weighted assets. If we look at the impacts, we see that it's quite imbalanced in the sense that primarily banks from Germany, Denmark, Finland, France, Netherlands, and Sweden are affected, and some significant banks in other countries, whereas other banking sectors are much less or not at all affected. What we see that if you just look at the EBA impact on the regulatory capital ratios, the impact is fairly limited. However, we have to see what kind of expectation there is from the market, from the banks, in terms of the capital surpluses that they would have to hold on top of the legislative and also supervisory requirements. We might, of course, also see that supervisors might respond and adjust some of their requirements. So all that might have an impact, but in, say, the worst case in terms of how much shortfall would be experienced, it could be as much as 10 times as high as just considering the minimum capital requirements. Now, looking at the impacts, in particular, if there is a limited shortfall to address, it can be really well addressed with the retained earnings in a relatively fairly short period of time. At the moment, that's not enough. Issuance of capital might be possible, but not for all banks. Of course, there it also very much depends on the market sentiment at the moment that banks would have to issue. Of course, last year we saw a huge drop in the valuation, and now there has been some recovery, but the market sentiment is still not ideal potentially for banks given the uncertainty. So that might for many banks be an unattractive scenario, also given the returns on their equity. So then they might have to look for alternatives in deleveraging and portfolio rebalancing. Those might, in particular in the medium to long run, have most impact on the real economy. So yeah, ideally, you would like to smoothen the process as much so that this impact is as limited. Then you would, for instance, also consider on how to implement the output floor. I won't go too much into this. I think we're going to discuss it most probably at length later on. But there are some good arguments to potentially say, for instance, apply a stacked approach rather than applying it on the full current ratios. Now, I think these are the main conclusions. If we look at the policy recommendations, one is really looking at how to apply the output floor, potentially focus more on the existing supervisory measures to improve the risk weights rather than apply these, say, the 72.5% on all risk weights without considering whether those risk weights are actually less risky or not. Then, of course, there is a need to really look at what is happening at the moment that the Basel III Finalisation is going to be implemented, in particular across certain countries, certain sectors. How are banks going to respond, and potential unintended consequences should be mitigated when experienced. So this is a brief overview of the main results, conclusions, and policy recommendations. I would like to give it back to Cynthia. Of course, you can find the entire report soon on the SEPS website.
Many thanks, Willem, for this overview of the results. I mean, of course, the topic it's very complex, and given the context in which we are today, assessing the cost and the benefits of the implementation of Basel is a very complicated exercise. But I think the thinking in terms of scenarios can really help to disentangle all the different drivers. Now, I would like to invite everyone who has a question to use the Q&A function, which is available at the bottom of your screen. You can type in the question, and then we can raise them with the speakers later on. For the moment, I would like to invite the two other speakers to participate in the discussion, and in particular, I would like to give the floor to Almoro Ruban de Servan, is head of unit at the European Commission in DG ECFIN. I mean, the Commission remains committed to the implementation of Basel, and is actually preparing a legislative proposal on the implementation. So in this sense, I'm pretty sure that within the Commission there is a lot of sorry, the DG FISMA. I think I made a mistake for speaking, sorry. Sorry about that. So there is a lot of discussion within the Commission about this issue, which is really work in progress. So I would like to invite Almoro to comment on William's presentation, and also to raise all the points which are relevant about the discussion. Almoro, the floor is yours.
Thanks, Cynthia. Good morning, everybody. And thanks, Willem, for the very interesting presentation and for the good study. Indeed, we are working on the implementation like we did on the past Basel reforms. Indeed, I think we have a problems with the numbering, 2, 2.5, 3, 4. I think probably the best is to call the finalization of the Basel standard, because that's what it's about. And it concludes a long process, a long and complex process of reform. And if you allow me 2 steps back, one is precisely this is a completion of a process which started more than 10 years ago, as Chita was saying at the beginning, and so is addressing one of the remaining elements. And a second step back is also, this has been discussed now for quite some time. It was supposed to be presented and negotiated already last year, but obviously last year was a very particular and uncertain period, and so it was postponed by 1 year. This has allowed also to take more time to look into the things, to do analysis, has brought at some time a bit of uncertainty, because the exit which is taking place has some uncertain shades. On the other hand, the reform which we're discussing has also a long period of implementation. So we also have to take that into account. And I was struck by in the presentation by Willem, actually, of the difficulty of assessing the potential impacts, given all the intricacies, the possible responses by the banks, and the interaction between the measure output floor with existing measures, Pillar 2 or other macroprudential measures, plus the interaction with other measures that are in the package. So actually, it's a very complex package, not necessarily very consistent internally, because it's sort of finalizing the Basel reforms. And so we're looking at the impact in terms of overall. I think it is a necessary package, because it addresses one of the issues which remained attached, and which is to some extent the risk sensitivity, the issue of models, and the fact that the models are perceived and also have shown that there are a lot of inconsistency in the modeling by the banks, to an extent that supervisor, despite the significant exercise like the one that the ECB has been carrying out, feel a bit of unease to see the differences and inconsistencies between the models. And so the supervisors together in the Basel context agreed to sort of put in particular a floor to sort of limit the advantages that bring to the model brings to the banks. By doing that, by design, the measures sort of reduce risk sensitivity and might have an impact on very conservative banking model. I think that's a bit of the design. We're working on an implementation, and we hope to come forward with a proposal in the September, October. So I'm afraid I cannot say much on the details, also out of respect of the colleagues with whom we are working in other DG in the college. So that limits a bit what I can say. What I want to say, though, is that we intend to implement the reform faithfully to what we ourselves also contributed to the discussion, using the options which are left, taking into account the European specificities, and also being mindful of the fact that one of the objectives is to ensure that this does not have an overall significant impact on capital, and that's should be normally the case. We're doing the assessment ourselves, but actually, as confirmed also by your study, even under the most conservative implementation scenario, and taking into account the long period of implementation, we actually would think that the impact would be more in the single digit than double digit. So from that point of view, we are not too concerned that this has a significant macro impact. The implementation might have an impact on some banks, which might be more outliers compared to the overall sample of banks. But it's difficult to do an implementation which is based on the outliers rather than on the average. And so that's something that we need to look and to analyze. One of the aspects that also, in particular, the implementation of the output floor brings is that a number of measures that have been put in place by supervisors, Pillar 2, or by macro authorities actually were introduced in particular because of the models. I had a stint of 2 years as a head of the macroprudential unit, and I do recall a couple of member states introducing macro measures precisely to address the fact that they were thinking that the models were underestimating the risks, and so they had a buffer. Obviously, with the introduction of the output floor, those buffers would come down, and so probably this would net out significantly. It might not work to all in the same way, but I think that would be that would probably bring the impact to very reasonable level. And final point on the macroeconomic effects, the ECB analysis actually is to show that there is a very limited short-term effect, but very limited in the 0.05%, which is very, very limited, but actually very beneficial in terms of upward permanent shift in GDP of 0.1, so double. Part of this, I think the explanation of why is this is also the measure by addressing the variability of models. It sort of reduces the uncertainty from investors on the banks themselves, and so should bring a significant element of trust in the banking system, which in turn should also have positive effects. And let me say that conversely, if we would do an implementation which would be very diverging from the standard, we would actually risk of generating doubts about the models, about the health of the banking system. So I think it's an element that we need to take into account as well. But I'll stop there. Thank you.
Many thanks, Amaro, for your comments and also for bringing in the macroeconomic impact. I think it's, I'm macroeconomist by background. I cannot prevent myself giving importance to this aspect, but maybe we'll come back to it later. I would like now move to the third speaker. Ulrik Nordgaard is Managing Director at Finance Denmark, which is the business association for banks, mortgage institutions, asset management, securities trading, and investment funds in Denmark. I would like to start from the point that, as William highlighted, but also Almaro mentioned, the impact of the implementation of this reform is likely to be uneven, with certain countries and certain banks potentially more impacted by the change. I would like to give you the floor to voice maybe this element. Ulrik, the floor is yours.
Thank you so much, Cynthia, and thanks to William for a good presentation. Yes, and let me start by saying that I speak today also on behalf of my Swedish and Finnish colleagues. We share the world view on this issue, I can assure you. So really, this is an important work, and it's important because these are large numbers. This is not some small technical file. As William's numbers also showed, this is a increase on average in Europe of capital requirements of, say, in the order of magnitude of 20%. But what comes out also quite strongly from this report is that indeed, as you also hinted at, Cynthia, that there are large regions in Europe that are hit much more significantly, in the order of magnitude of, say, 30%, in Denmark even 35%, and that is indeed the Nordic countries. It's also France, Germany, the Netherlands. So it's more than what I would call outliers. This is a significant part of Europe that is affected quite harshly. And indeed, as you also mentioned, Cynthia, there is a economic angle to this. So looking at EBA did a study of their proposed implementation and came out with the result that over the first 4 years, GDP would be reduced by 0.8%. So I saw a recent impact study of the recovery fund that a lot of European policymakers are putting a lot of effort into. It said that under reasonable circumstances, that would lift GDP in Europe by 1.5% over the next 4 or 5 years. So essentially, using the EBA and not something we have cooked up here in the banking community, essentially you're taking out half of the impact coming out of the recovery fund. I think this just goes to show that having been through COVID-19 and all these political endeavors that has been done basically in all member countries to get the economy through, it would be a little bit strange then a few months later to do a policy proposal that really has a marked negative impact on GDP. So there needs to be some rethinking here on the order of magnitude. I also think that what was Mauro was hinting to, the earlier ECOFIN conclusions, that there should not be a significant impact. Clearly, these numbers that William have presented constitute a quite significant impact, so something needs to adapt. And I think what the numbers SEPs have presented today also shows that indeed, if you want to bring down the impact, there's no way around looking at the output floor one way or the other. This is the main driver, and in particular also in those countries where the effect is the largest one. So that's in itself a good argument for looking at the output floor. The second good argument is that the output floor and the whole idea of that is basically in conflict with good risk management practices, because essentially you're going away from that old supervisory principles, that is that risk and capital charges should go hand in hand. So there should be a risk-based approach to this, and if you implement the output floor as it in its most rigid form, you are essentially suspending that principle. So let me give you two examples. So mortgages. In Denmark, we have, for various reasons, a mortgage system with strong creditor rights that essentially imply that the losses are quite low. They have been for decades. It's well documented. It has been tested in practice in the housing bust, the early 90s, and also during the financial crisis. So this is not theoretical speculation on the model. It has been tested in practice. Essentially, what the output floor implies that those mortgages should be treated as, say, mortgages in the US system where you can leave your key behind and so on. It doesn't make sense from any risk management perspective. Another, let's go to the corporate world. So large, well-consolidated, long time ago established corporates, if we implement an output floor in Europe as it stands now, essentially they will get the same treatment in terms of riskiness as a newly established pizzeria. I mean, that goes against any intuition about risk. So we need to rethink this part of the package. Of course, we need to do it in a manner that respects that we have done some international agreements here. And indeed, we have a proposal that we think strike that balance quite nicely, and that is the so-called parallel stack approach, which essentially, as William also hinted at, is a solution where we implement faithfully the output floor, but we only do it in connection to those capital requirements that are agreed upon at the international level. So the extra national and European add-ons coming from Pillar 2 or national sci-fi buffers and so on, we leave them out of the calculation. So essentially we get, as the name suggests, a parallel stack. We get a risk-based capital requirement and a sort of backstop based on the output floor. That's the general idea. We have also in the European Banking Federation hired some legal experts to do a legal opinion on that, and they also reached the conclusion that this is consistent with what has been agreed in Basel. So we really think that is the way forward. That would imply that for many banks, the risk-based requirements would still be the binding ones, and that is exactly what we are after, because when you do it in a risk-based manner, you get the right incentives for banks. You don't punish banks for taking low risk, you incentivize them to have low risk customers, and that is the way it should be. So hopefully, we hope that the Commission will take that on board in thinking towards October and presenting a proposal. We certainly will work for that kind of model. I think that's right for Europe. Thank you.
Many thanks, Ulrich. I would like to give the possibility to Almoro to react to what Ulrich said.
Sure. I would like to point out two aspects. Ulrich, I think it's completely incorrect to compare the impact of the Basel implementation and so to and compare it with the impact of the recovery fund, because what you have to do is compare the relatively impact of doing the proposal or of not doing the proposals. That is the relevant impact analysis that you have to do. And frankly, the little game of being this has a negative GDP impact, so you're vanishing the efforts of the recovery fund is completely incorrect, because one could easily argue that not doing the reform, and so leaving quite some uncertainty on the European banking system, also in terms of international competition, might also have a negative impact, and probably would have a negative impact. So you would have actually what of the two negative impacts you would be looking at. So so I think it's more difficult to do an estimate of what would happen if we do nothing, because to some extent this would trigger a number of reaction by markets, by other supervisors. So and it's very difficult to model that. But I think that would be the correct one. On the fact the output floor is in conflict with good risk management, it does not suspend; it limits the benefits. So it is. And when it was sort of first introduced, I also thought that it went against the philosophy of sort of incentivizing good risk management. At the same time, the supervisors were around the table; they work on that. And if you look at the position of the ECB, Maria gave a number of speeches. I think they are also very comfortable with the idea that that's a standard which has been agreed internationally. It reduces a bit the benefits of the model, but it keeps a number of benefits from modeling. And so from that point of view, I think they are they're happy with it. And if the supervisor is happy with it, and who am I to say no, he's in the wrong position? So from that point of view, I think that it is less beneficial in terms of advantages of modeling that is giving, but it still gives models some advantage. Final point on the real estate and the low risk weights. When I was mentioned, as I mentioned before, I was in charge of macro pru. I also was surprised by some of the macro pru measures, but so actually I tried to convince my interlocutor at the time, said, are you sure you need to challenge the models and put buffers because the models underestimate risks? And they were very adamant that yes, no, the models are frankly underestimating the risks because, and I think they were in a sense, even if the history goes back, you have tail risks, and they wanted to have a level of security which was not present and models were not delivering. And so, and I think that's also explained the different position of the countries impacted on the proposal itself, and the different situation, because some do have a lot of Pillar 2 and macro pru measures, and so can absorb the impact of the output floor, and some have less, and so are more impacted. And so I think that's also, but the interesting is among the Nordic countries, you had very different reactions in the past years from supervisors, precisely on the very low risk weights, and it was interesting to see. Thank you.
Many thanks for this. Maybe just Ulrich, please. Yeah. Okay. Well, thank you. Just to get the discussion going. So I think this point about potentially large consequences for doing something that could look non-compliant in vis-a-vis the Basel agreements. I think this argument should not be overestimated. I was present at the EBA Board of Supervisors back in 2014, where there came this valuation out saying essentially that the EU was non-compliant due to counterparty credit risk and SME discounts and so on. And there was a lot of talk and a lot of worry when this comes out. Will this sort of fall back on European banks and not be good in terms of confidence? And essentially nothing happened. And I think if we do a sensible thing that is loyal to the spirit of what has been agreed, but maybe done in a little bit different way, I'm sure that the European banks will not sort of experience a loss of faith. I'm sure we can do that. Then on internal models, maybe just a few words, as you also rightly explained, Almoro. There's just been this huge exercise done by the ECB going through various models and raising risk-weighted assets as a consequence of that. I think it just goes to show that this idea that internal models is just something the banks can play and pick the numbers themselves and so on is not right. There really is a lot of supervisory attention to it. I think a lot of the work that EBA has been doing in this dimension, trying to harmonize the definitions of defaults and so on, has also really pushed us in a better direction. So a lot has been done in terms of addressing these sort of apparent inconsistencies. And then on the Nordics and risk weights on mortgages, I think it's important to say, the EBA has been looking into this area, doing benchmarking, and indeed there is a complete consistency between risk and risk weights in this area of real estate. Then it's true that some have been more active macroprudential policy players. But I can only say, in Denmark, for instance, there is the Pillar 2 requirements. They are not addressing any issues regarding worries about risk weights. They are there for completely other reasons, so there wouldn't be any offset. It's also my impression that in some of the Nordic countries, these so-called add-ons have been converted into Pillar 2 measures now. So there will be no automatic reduction coming from introduction of an output floor. And let me then again stress, and this goes for all the Nordic countries, that looking over decades of data, the losses have been small. We need to reflect on that. If that should be taken into account when we sort of design the system. Thank you.
Many thanks. We have quite a lot of questions, so I would like to submit at least some of them, given the time limits we have, to the panelists. I would like to start with the first one. Is a participant who has been very patient because the question came in at quite early stage, and this a clarification basically on the presentation that William made about the use of retaining earnings to rebuild capital level. And basically, William, if you can elaborate a little bit on the time horizon that you are considering in the exercise.
So we take as a starting point June 2020, and we consider the profitability on 2019, but also we have alternative scenarios with the profitability on the first half of 2020. And that's what we use in terms of retained earnings. So we basically calculate the shortfall, then divide it by, for instance, the 2019 earnings to see how many years would be required. So you can apply this from the point of June 2020, but you could also apply it from the moment that the European Commission proposes, and then of course when the proposal is adopted, I think the Commission always anticipates that in principle you can start addressing the initial measures as soon as they are on the table, and maybe some could already say, okay, they have been agreed by Basel, so you could already have started in 2017 addressing some of the challenges. So in that sense, you could take a bit 7 to 10 years in that sense.
Thanks, Willem. Then there is a second question, which I would like to submit to Almoro. There is participants highlighting that, some people are now calling for a revision of the Basel framework more in the direction of better integrating ESG risks. So the question there is, instead of focusing on the implementation of Basel and coming up with another round of amendments to the directive, should we not move towards something which is more encompassing and different in this direction?
No, thanks. Good. It's a good question. Two angles from that. There is a supervisory and risk angle, and then there is the broader question of how to introduce risk weights or sort of brown or green factors in the process. I won't say much, also because we will be publishing next week the sustainable finance strategy. So I let the announcement for what we're going to do exactly into that. But just to say today that so we're aware of the dimensions. We will do something in September. At the same time, EBA is also doing a thorough analysis of the more deep dimensions on the interaction with the prudential framework. I'll stop there, but indeed, it's something we're looking into.
Thanks very much. And then a question for Ulrich. Can we still change the EU approach without creating an international fuss? So without having an impact on the credibility of the system in general, and the European banks, sorry.
As I said, I think what we acknowledge, I mean, an international agreement has been done, and so what we are not going around saying, okay, we should just put the output floor outside the door and just take the rest of the package. We acknowledge that is not a realistic option, and that's also why we've been looking for solutions that could sort of balance, as I also think Almoro hinted to, the European specificities at the one end and the international agreements at the other end. We think we found a good solution here. It's clear there are different viewpoints on this. As I said, we've been looking at it from a legal perspective in the banking community and find evidence it's consistent with what has been agreed. I know there are other views out there, and surely we acknowledge that. But I also think we, as I hinted at earlier, we need to reflect on not exaggerating the consequences should it be that we in some future evaluation get a non-compliant character or grade there. We have done that before on the SME discount, on counterparty risk, and so on in specific areas. I think the important signal to the rest of the world would be that we are indeed implementing the output floor. It will limit the degree on which internal models can reduce your risk rates and so on, but we're doing it in a manner that is more consistent with the way we do banking here in Europe, because here in Europe we tend to have a lot of low risk exposures on the balance sheet. In the US, where this practically has no impact at all, they tend to have sort of sold off the low risk things. I think the track record, also going back to the financial crisis, we have a good model in Europe. So it would be, if I could use a term from the current championship in football, it would be a little bit of an own goal to implement a model that fits better with what we see elsewhere in the world. We should make small amendments so we get the best of the both worlds. We get something that acknowledges we have some commitments internationally, but at the same time we do it in a manner that's good for Europe.
If I can, Cinzia, react quickly because we're finished in time. I see Ulrich's point. I think there is a degree on how much you can play with standards, in the sense, and I'm not sure the supervisory community shares the view that you pick and choose from the Basel standard in terms of what you apply the output floor to or not. So I think that's one of the issues which are relevant. On the low risk activity, I maybe because I had worked on that in the past, I hope at the same time this acts as an incentive for firms to use a securitization framework, which is now up, running, complete, and working, and that actually would also help capital markets. So maybe actually if this has an incentive for firms to banks to securitize more, that actually would not be a bad result.
Well, I would tend to disagree on that. I think that the track record, I mean, so we have housing financing systems that have been working for decades quite well. And then we have another way of financing that, which didn't work quite well during the financial crisis. Introducing that instead of doing a more flexible implementation, it would seem, at least from our perspective, as an odd choice. I agree that certainly securitization is part of the toolkit for large financial institutions and so on. But I think going the American way on how we finance mortgages, just to be 100% consistent with what some people think has been agreed, I think that's going a bit too far.
Yeah, we're not going the American way. In any case, we don't have the two agencies backstopping the entire system. So we're not going, we won't go, and we can't go the American way.
Maybe just a follow-up on what we have been discussing now, because there are several questions hinting at what would be the consequence of not fully implementing Basel. Anything that you would like to add on this?
It's difficult to. First, there is a credibility issue. So you negotiate something, and it's very relevant for people like us who actually participate in Basel. Very relevant to our commissioners, to the ministers who actually go to the G20, subscribe to these issues. So there is a credibility issue politically, which is relevant, and I think we should not underestimate it. There is a second question, which is how would markets perceive that if the mark from the Basel Committee would be more materially non-compliant than already is. And I think the material non-compliant mark, it is, I think, accepted as non-relevant, probably because the Basel Committee went too far in the defining material non-compliance for just two deviations, which are very targeted and very small. How far this would work, it's an open question. And I think then there is the more complex question of what will be the reaction of the other supervisors and regulators on a significant deviation from the EU, for instance, for the European banks internationally active. Would they then sort of see them as more risky because of that? Would they see them that we would be undermining international level playing field? And so how would they react and retaliate? And so the cumulative effect would probably be negative. The sentiment for markets on banks might turn negative as well, particularly if the deviations would be perceived as a sign of weakness. So it's very uncertain how all this, and I'm doing on purpose the reaction in terms of most negative, but these are potential effects that we have to take into consideration in going forward.
Thanks, Ulrich.
Yes, thank you. And to start with the sort of the potential sort of in terms of confidence and I think we should not underestimate market participants, and so I think they can look through all this and disentangle what's really is the European business model risky or is it not, and so on. Then of course there is, as Almoro said, this thing about in the regulatory world could there be some kind of ramifications coming from doing something that would look as if it's not 100% compliant. I mean, surely you cannot rule that risk out. As I said, we had a similar discussion if 5 or 6 years ago. A lot of worries, how was this to be taken down? That European Union, as a very large actor, was giving the great non-compliant and so on. In the end, it didn't really spur a lot of reaction. I also think it's important to say that I mean this discussion would be more relevant, I think, if we basically just left out the output floor from the implementation. There, it would probably be seen as a quite provoking thing to do. But here we're trying to address it and implement it in a way that fits with Europe. I'm sure we could persuade our foreign colleagues that it's done in a mindful manner. But of course, we wouldn't know. But I think it's quite clear when it comes to confidence and the view on the European banking sector from investors, and so I think they can look through all this. I mean, I wouldn't worry about that for 1 minute.
Thanks. I would like now to move to William. That there is a question which is on the fact that what is in fact the meaning of saying that the output floor of 72.5% is too high compared to the underlying risk. William, would you like to comment on this?
Yeah, I think the output floor is a tricky one, and in particular the percentage. And I understand that also at Basel they had quite some issues in determining what is the accurate level. And it is in our view it's quite a bold measure, but which actually is unlikely to do what it's aimed to do in Europe. What do I mean with that? The output floor is primarily there to address the excessive, tricking, gaming of the internal ratings-based approach. It's also aiming at making the ratios more comparable. Now, if we look, for instance, at the results of the exercise that the ECB has done, we see that for most of the banks, this, say, gaming or trying to play the system is in the range of somewhere between 6 and say just over 10%. So if you know that, then 72.5% is not going to do the job to address those banks that have these kind of changes. So for that, you still really need the supervisory exercises, and I think the ECB has set a good step in that direction, and most probably needs to do more in the future, because I think also there it seems that it's still work in progress, and that seems to be the real way of addressing these kind of games. If you then see at those exposures that have these very low internal model-based risk weights compared to the standard risk weights, we see often that there is something else going on. This consists on the exposures that Ulrich said about the mortgages, on which we have a long track record. We have many observations, quite a few default events, so we can predict quite well how these portfolios are behaving in crisis situations. But on the other hand, we also have high exposures, low default examples, but there might be in the future just because we don't have a long enough period, we haven't stressed it enough in the past. So I think also that is a distinction, at least I read for sure between the lines in ECB assessment. So in particular, that second part, those exposures are more of a problem than the first part, where we have this longer and we know much more about and how they behave. And those have these low risk weights, and it might be that these risk weights are actually justified. And an output floor would potentially be punishing that with the 72.5. So this would be the types of exposures that are most likely to be hit with this 72.5%. And then, of course, and I think also that's a bit reflected in the question, you're going to ask, like, what is the problem? Is it maybe not necessarily the output floor that is the problem, because that 72% might be even too low, but it might be the standard risks weights that are applied to these kind of exposures. So maybe some of these exposures would have to receive a different risk weight already in the standard approach. Now, this is, of course, something that we as Europe, if we want to follow Basel, are not able to address, but this might actually be the real solution going forward in the next revision maybe of Basel. And then you can also better apply an output floor, which then might be even higher than the 72.5, because you have addressed the issue of some of the exposures that are, say, misjudged by Basel more fundamentally. So I think that's one point. Maybe also one other point referring to some of the things we are discussing, and that's, I think, like we see a very much a focus of policymakers on the regulatory requirements, and I think increasingly we're looking at margins on top of regulatory requirements. So I think things like supervisory guidance, but also the bank's own decisions on how much to hold in excess is becoming even more important, as the trigger for failure is not the 0% capital, but is actually be the capital requirement. So I think also on that sense, it is important to look at these capital reforms, not only at the minimum requirement, but also look at the excess. And having sufficient excess is very much a priority, I think, in the daily work of banks, but also for the supervisors, very important to ensure that the banking sector is stable. So I think also from that perspective, it's more important to focus on things like buffers guidance than focus on having very high minimum requirements. So I think that's another aspect that is interesting and also reflects a bit what the ECB kind of approach has taken during COVID, where it really allowed banks to use temporary the buffers in case of losses as a consequence of the latest crisis.
Thanks, Willem. Ulrich, would you like to react to what Willem just said?
Yes, I would really like that. Just to maybe shed a little bit of detail on when you see a lot of corporates having low risk weights. I mean, this is not about gaming or anything like that. This is because they are low risk. And to give an order of magnitude, I mean, and I don't say any numbers regarding these firms, but just to give you a picture. So what we're talking about here are companies like IKEA and Lego, these kinds of companies that I guess many of you would know, well established and so on. Now, it's not unrealistic that those kind of companies would, in using internal models, get a risk weight of say 20%. And if you apply a 72.5 floor to the standard risk weight of 100, you end up at 72.5. So that's like a tripling. And it's completely unwarranted in terms of risk, because these companies rarely do default. So that's why exactly it has. And that's also why I think it's very dangerous to, I mean, there's a reason why the supervisory community suggested moving from just standard models to internal models to get better risk management. That was essentially a push by the supervisory community. Let's remember that, because it doesn't make sense to say, no matter what kind of company you are, you get the same risk weight, whether or not you're new to start a pizzeria or you are a Lego or IKEA. So this is a problem, and the 72.5, as I was trying to illustrate with the numbers, will imply a significant increase to many European large, well-consolidated companies. So we need to fix that.
If I may point on the 72.5%, this obviously is a compromise. It's a compromise between Europeans that wanted to a much lower output floor, and non-Europeans and some Europeans, including Nordics, wanted a much higher output floor. And so, as often the case, you arrive to a non-scientific compromise, which, however, has the merit, and that's one of the objectives of the Basel standard, is a level playing field. It does have effect. It does have an impact. To some extent, if you look at the European system, yeah, it has an impact in the low risk. It incentivizes the use of capital markets, though, for instance, for large corporates, and reduces the dependency on the banking system. And so, yeah, it pushes a little bit the banks to take a bit more risk, maybe to get more return as well. So I think, from that point of view, it does something which is not inconsistent with the overall policy. But and frankly, one of other points, I think the tail risks are more significant than we think, because we tend to think that things go normal. Have we seen last year that suddenly the entire economy can change for a reason? That can apply for a single company as well. So even a company with a long history of things going well can suddenly find itself, for a variety of reasons, in a completely different position. And so, so that hence the prudent approach. So now is 72 the right figure? Is higher to low? I think that's where it's a compromise, and all compromise has its limits, but has the benefit of being a sort of settled figure across the globe.
Many thanks to all for this very interesting discussion. We have reached the time and we need to close. I will not even try to summarize what it was said, but what is clear is that views are still quite different, and I'm sure there will be other debates about the finalization of Basel III. Many thanks to all for your insightful comments and inputs, and many thanks to all those who attended. And actually, I have to apologize because we didn't manage to respond all questions, as there were many asked. Many thanks, and have a good rest of the day. Bye.
Thanks to you. Bye-bye.